Welcome to the magical world of Disney's business empire. Most people think of Disney as just movies and theme parks. But did you know Disney owns over 12 TV networks and controls 11 theme parks worldwide? In 2023, Disney's parks alone brought in over $20 billion. Here's a shocking fact. Disney Plus gained over 100 million subscribers in just 18 months after its launch. That's faster than any other streaming service in history. And did you know Disney owns the rights to The Simpsons, Marvel, and Star Wars? In this video, we'll dive deep into Disney's diverse portfolio. We'll explore how they generate billions from theme parks, media networks, and their massive collection of beloved characters. We'll uncover hidden treasures in their IP vault, reveal financial strategies, and discuss how they adapt to market changes. Ready to discover why Disney is a value investor's dream? Let's unlock the secrets behind the magic. Chapter 1. Unpacking the magic. Disney's multifaceted business model. Disney's business model is more diverse than most people realize. It's not just about Mickey Mouse and fairy tales. The company operates in several sectors, each contributing significantly to its revenue. Let's break it down. First, Disney's theme parks and resorts are a massive part of their business. They operate globally, from Disneyland in California to Disneyland Paris and Shanghai Disney Resort. In 2023, these parks generated over $20 billion in revenue. Disney also owns numerous TV networks, including ABC and ESPN. These networks reach millions of viewers worldwide, driving substantial advertising revenue. ABC alone has been a cornerstone of American television for decades. But it doesn't stop there. Disney's acquisition of 21st Century Fox in 2019 expanded their portfolio further. This deal brought in valuable assets like National Geographic and a controlling stake in Hulu. Speaking of streaming, Disney Plus has been a game-changer. Launched in November 2019, Disney Plus gained over 100 million subscribers in just 18 months. This rapid growth showcases Disney's ability to innovate and adapt. They didn't just stop at one streaming service. They also offer ESPN Plus and Hulu, catering to diverse audience interests. Disney's film studio is another powerhouse. The Marvel Cinematic Universe, Pixar, and Star Wars franchises are box office giants. For instance, Avengers: Endgame grossed over $2.8 billion worldwide, making it the highest-grossing film of all time. Merchandising is a less visible but crucial part of Disney's revenue stream. The company's characters and franchises are licensed on everything from toys to clothing. This segment alone brings in billions annually. Fun fact: in 2018, Disney merchandise sales reached $54.7 billion globally. An interesting aspect of Disney's business model is their synergy strategy. They create a seamless integration between different business segments. A new movie release doesn't just hit theaters. It appears on Disney Plus and gets promoted through TV networks, theme parks, and merchandise. Disney's Cruise Line is another unique venture. These cruises offer themed experiences and generate substantial income. In 2019, Disney Cruise Line was named the top cruise line for families by Travel Plus Leisure. One of Disney's most intriguing strategies is their focus on storytelling. Every aspect of their business, from parks to movies, revolves around compelling narratives. This storytelling prowess is a key driver of customer loyalty and brand strength. Bob Iger, former CEO of Disney, once said, "The heart and soul of the company is creativity and innovation." This philosophy is evident in Disney's approach to business. They continually push boundaries to create memorable experiences for their audience. Disney's investment in technology also sets them apart. They've embraced new technologies like virtual reality and augmented reality to enhance their offerings. For instance, the Star Wars: Galaxy's Edge attraction at Disneyland uses cutting-edge tech to immerse visitors in the Star Wars universe. Chapter 2. Hidden Treasures. Analyzing Disney's Intellectual Property Vault. Disney's intellectual property, IP, vault is a goldmine. It's filled with iconic characters and stories that have captivated audiences for generations. Let's explore how this vast collection adds value to Disney's portfolio. The Disney Princess franchise is a prime example. Characters like Cinderella, Ariel, and Elsa are globally recognized. These characters drive revenue through movies, merchandise, theme park attractions, and even Broadway shows. In 2019, the Disney Princess franchise generated over $5 billion in retail sales. Marvel's acquisition in 2009 for $4 billion was a strategic masterstroke. The Marvel Cinematic Universe, MCU, has since become a cultural phenomenon. Movies like Black Panther and Avengers Endgame have not only broken box office records but also boosted merchandise sales and theme park attendance. Star Wars is another jewel in Disney's IP crown. Since acquiring Lucasfilm in 2012 for $4 billion, Disney has revitalized the franchise. New movies, TV series like The Mandalorian, and themed attractions at Disney parks have reinvigorated the Star Wars brand. The franchise has generated over $70 billion in total revenue since its inception. Pixar's animation studio is renowned for its storytelling and innovation. Films like Toy Story, Finding Nemo, and Inside Out are beloved by audiences of all ages. Pixar's movies consistently perform well at the box office and win numerous awards, enhancing Disney's brand reputation. Beyond the big names, Disney has a treasure trove of lesser-known but valuable IPs. The Muppets, for example, have a dedicated fan base and generate steady revenue through TV shows, merchandise, and theme park attractions. National Geographic, acquired through the Fox deal, adds a unique dimension to Disney's portfolio. It provides high-quality educational content and has a strong presence in print, television, and digital media. National Geographic's brand is synonymous with exploration and learning, appealing to a broad audience. Disney's strategy of revitalizing classic IPs is noteworthy. They've successfully remade animated classics like The Lion King, Beauty and the Beast, and Aladdin into live-action films. These remakes not only introduce the stories to new generations but also drive box office success and merchandise sales. The Disney Vault strategy is a clever way to create scarcity and demand. By periodically re-releasing classic films, Disney ensures that their timeless stories remain relevant and highly sought after. Disney also leverages its IP in innovative ways, such as through video games and mobile apps. The Kingdom Hearts video game series, a collaboration with Square Enix, blends Disney characters with popular video game characters, creating a unique and engaging experience for players. Licensing is another critical component of Disney's IP strategy. They license their characters and stories to other companies, generating significant revenue without the overhead costs of production and distribution. Disney's focus on quality and consistency in their IP management is evident. They maintain strict control over how their characters and stories are used, ensuring that their brand remains strong and cohesive across all platforms. Chapter 3. Pixie Dust Economics, Financial Metrics That Matter. When evaluating Disney's financial health, there are key metrics to focus on. These numbers help investors understand the company's value and growth potential. Let's dive into some important figures. Revenue is a primary metric. In 2023, Disney reported over $82 billion in revenue. This includes earnings from theme parks, media networks, and streaming services. Net income is another critical measure. Disney's net income for 2023 was approximately $8.1 billion. This reflects the company's profitability after all expenses are deducted from total revenue. Earnings per share, EPS, is essential for investors. Disney's EPS in 2023 was around $4.50. EPS indicates how much money shareholders would receive if the company distributed all its profits. Free cash flow, FCF, is vital too. It shows the cash a company generates after accounting for capital expenditures. In 2023, Disney's FCF was about $3.8 billion. This cash can be used for dividends, debt reduction, or reinvestment. Disney's debt-to-equity ratio is an important indicator of financial stability. A lower ratio is better, as it means the company is less reliant on borrowing. In 2023, Disney's debt-to-equity ratio was 0.55, reflecting a balanced approach to financing. One unique metric for Disney is average revenue per user, ARPU, for its streaming services. For Disney+, ARPU was $5.96 in 2023. This figure helps gauge the profitability of their growing subscriber base. Theme park attendance is another key indicator. In 2023, Disney parks welcomed over 157 million visitors. High attendance drives revenue from ticket sales, merchandise, and food. Operating margin is crucial for understanding efficiency. Disney's operating margin in 2023 was 20%. This means that for every dollar of revenue, 20 cents were profit before interest and taxes. Return on equity, ROE, measures how effectively Disney uses shareholders' equity to generate profits. In 2023, Disney's ROE was 12.5%, indicating solid financial performance. Subscriber growth for Disney Plus is a key focus. The service reached 146 million subscribers by the end of 2023. This rapid growth highlights Disney's successful pivot to digital content. Disney's capital expenditures are worth noting. They spent about $4.5 billion in 2023 on new projects, including park expansions and streaming infrastructure. This investment aims to drive future growth. A lesser-known but vital metric is customer lifetime value, CLV. For Disney Plus, CLV is estimated to be around $500. CLV helps predict long-term profitability from each subscriber. Chapter 4. Evolving with the Mouse, Disney's adaptation strategies. Disney's ability to adapt is a key reason for its enduring success. The company continually evolves to meet changing market conditions and consumer preferences. Let's explore some of their adaptation strategies. One major adaptation was the launch of Disney Plus. In response to the growing demand for streaming services, Disney entered the market in 2019. By 2023, Disney Plus had over 146 million subscribers, proving their ability to pivot successfully. Disney's focus on original content for Disney Plus has been a strategic move. Shows like The Mandalorian and WandaVision have attracted millions of viewers. This original content keeps subscribers engaged and loyal. The integration of 21st Century Fox assets has been another significant adaptation. This acquisition expanded Disney's content library and brought valuable franchises like Avatar and The Simpsons under their umbrella. Disney has also adapted by investing in technology. The Star Wars, Galaxy's Edge attractions at Disneyland and Disney World use advanced technology to create immersive experiences. This investment enhances guest satisfaction and drives park attendance. Environmental sustainability is another area where Disney has adapted. They've committed to reducing greenhouse gas emissions and have invested in renewable energy. Disney aims to achieve net zero greenhouse gas emissions by 2030. Disney's adaptive strategies extend to their theme parks. They continually update and expand attractions to keep them fresh and exciting. For instance, the upcoming Avengers Campus at Disney California Adventure promises to attract Marvel fans from around the world. The company's response to the COVID-19 pandemic showcased their adaptability. Disney implemented health and safety measures at their parks and accelerated the rollout of Disney Plus. These actions helped mitigate the impact of the pandemic on their business. In the media segment, Disney has adapted by expanding its international presence. They've launched Disney Plus in over 50 countries and plan to expand further. This global reach helps diversify their revenue streams. Disney's focus on diverse storytelling is another strategic adaptation. They've made efforts to include more diverse characters and stories in their films and shows. This inclusivity resonates with a broader audience and enhances their brand. The company's partnership strategy is also noteworthy. Disney collaborates with other companies to enhance their offerings. For example, their partnership with Sony allowed Spider-Man to appear in the MCU, delighting fans and boosting box office sales. Disney's adaptive strategies extend to their merchandising. They continuously release new products and collaborate with other brands. Limited edition items and exclusive releases keep consumers coming back for more. Chapter 5. Beyond the Fairy Tale. Risks and Challenges in Disney's Portfolio. Disney is a powerhouse, but even giants face risks. Understanding these challenges is crucial for investors. Let's dive into the potential pitfalls Disney might encounter. First, the competitive landscape is fierce. Disney competes with other streaming giants like Netflix and Amazon. These companies are pouring billions into original content, intensifying the battle for viewers. Economic downturns pose another risk. During recessions, consumers might cut back on discretionary spending. This can affect theme park attendance and merchandise sales. For instance, during the 2008 financial crisis, Disney saw a significant drop in park revenues. Regulatory changes are always a concern. Disney operates globally, so they must navigate various laws and regulations. Changes in media ownership rules or content regulations can impact their business model. Technological disruptions are a constant threat. The rapid pace of technological change means Disney must continuously innovate. Falling behind in tech advancements could reduce their competitive edge. The COVID-19 pandemic highlighted another major risk: global health crises. The pandemic forced Disney to close theme parks and halt movie productions, leading to significant revenue losses. This scenario could happen again with future pandemics. Geopolitical tensions also pose risks. Disney operates in many countries, and political instability can affect their operations. Tariffs, trade wars, and international disputes can disrupt their global supply chains and market access. Climate change is an emerging threat. Disney's theme parks are vulnerable to extreme weather events. Hurricanes, wildfires, and other natural disasters can cause significant damage and operational disruptions. Intellectual property, IP, protection is another challenge. Disney's success relies heavily on its vast IP portfolio. Any failure to protect their IP rights can lead to revenue losses from piracy and counterfeit products.